And what a down round is when a company raises a new round of financing at a lower valuation than the prior round. Well, first of all, it means a lot of the prior investors are going to get diluted. So the value of the shares that they bought in the last round are now worth less. So they own less of the overall companies. That is obviously never a good thing, and something to always consider when you're investing is the impacts of dilution kind of long term on your investment. But even more so, down rounds are generally seen as a big negative for a company because, from an investor point of view, you have to ask what must be going wrong at this company for them to be raising a down round. And from the investor perspective, this can often be a very justified, way to look at it. A lot of times founders, they raise really big rounds at high valuations with these huge growth targets, and then they fail to deliver or they fail to execute in the way that they said they were going to. And this can be due to a lot of things, operational difficulty, revenue decline, margin decline, and additionally kind of changes in the overall kind of macro environment we saw in 2021 when a lot of companies were raising at valuations that made no sense. The multiples on their revenue were just crazy, and we saw a lot of down rounds throughout venture, not necessarily so much in equity crowdfunding, but in the kind of overall venture landscape. And even with some of the most well-known companies in the world, a lot of them raised at down rounds.